While equity valuations appear elevated across most traditional metrics, they are not disconnected from the broader macro and earnings backdrop. It seems clear that a lot of optimism is currently being priced in. We agreed that the consensus view that stock valuations are elevated by traditional measures, but valuations should be considered in the context of economic regime and earnings environment. Factoring in outlooks for economic growth, inflation, interest rates, and earnings, we are comfortable with the current 21 price-to-earnings ratio, or PE, for the S&P 500 index. Before you think about selling stocks because of valuations, keep in mind valuations are not predictive over shorter time periods. Additionally, inputs into these calculations change over time. Bolstered by fiscal stimulus from the One Big Beautiful Bill Act and massive AI investment, we expect the U.S. economy to grow by 2% in 2026, even if oil prices stay elevated for several more weeks. Despite these pressures, underlying demand remains firm, suggesting continued economic expansion. Importantly, elevated valuations do not signal an imminent market reversal. Markets can sustain higher multiples longer than expected when supported by solid fundamentals, though they also are more vulnerable to shocks when optimism is fully priced in. As this cycle evolves, monitoring the trajectory of rates, inflation, and earnings will be critical. Overall, modestly higher stock valuations are possible, but expect earnings and cash flow growth due to heavy lifting. In our view, the stock market is fairly valued at its current forward PE of 21 to 22, and further gains through year-end will likely be driven by positive surprises on AI adoption. If you've got questions about the stock market or your investments, contact us today at Oxroad Capital.